welcome to My Private Network podcast. I'm Bob Simpson, your host. Today we're diving into an exciting series focused on smart, income-driven investing strategies tailored for high net worth Canadian investors looking to preserve and grow their wealth in retirement. This episode is a recording of session 1 of our Investing for Income Summit held on November 13th. In this session, we unpack the fundamentals of private debt and equity investing, exploring how these strategies can be powerful tools for generating income and managing risk in today's unique market landscape. If you're looking forward to more, you're in luck. This is just the beginning. The summit continues with 2 additional webinars where we will be diving in even deeper. In session 2, we'll focus on advanced strategies for optimizing portfolio income. And in session 3, we'll bring in expert perspectives on capital preservation, tax efficiency, and more. Okay, let's get started. Here you go with session 1. Enjoy the discussion. Good evening, everyone. I'm Bob Simpson, Vice President, Portfolio Strategy for Wealth Stewards and co-founder of privatedebtandequity.ca, a platform dedicated to private lending and equity strategies for Canadian investors focused on income and capital preservation. I also host a podcast, My Private Network, which is available on Spotify and Apple, where we explore private investing in depth. Tonight's webinar will be recorded and it will appear in the near future as a podcast episode as well. So if there's something that you thought you missed tonight, you'll be able to go to that podcast and listen in again. Now, this is the first of 3 sessions in the Investing for Income Summit, where we're going to tackle some of the key questions that high net worth families are asking. How can we generate reliable income without taking on unnecessary risk? Traditional options like bonds and GICs are just not providing the returns that we need. And, interesting fact is that bond funds have actually returned negative over the last 3 years. So if you get a chance, look at your statement and just look at the bond portion if you own bond funds and see how you did over that period. This is where private lending offers alternative sources for stable income. Now, for tonight, we've gathered a panel of experts specializing in these investment strategies, each with a unique insight on the whole subject of generating income and managing risk for high net worth Canadians. We'll discuss the solutions to help secure your lifestyle amidst market uncertainties. So think of tonight as a behind the scenes look at some of the most stable income generating strategies available. I'm going to be asking questions tonight from your perspective, from the perspective of a high net worth family seeking to protect the wealth, maintain the income, and prepare for the future. Now, you're welcome to post your own questions via Zoom, and you can use the Zoom panel anytime. Just post it, and we're going to hold all of the questions till the end. And most of our panelists are going to be able to hang around for that Q&A session. Now, if you were looking at the agenda, you'll probably see that we've made a change. Ryan Dunfield is joining us this evening in place of John Hutchinson of Tres Capital. John ran into some travel issues and is not able to be here tonight. We want to thank Ryan because he jumped in at the very last second to help us out, so we appreciate it a lot. But he may have to jump out and not be able to, number one, we're not going to be able to get his video on this evening. And he may not be able to hang around for later. So jumping right in, Ryan Dunfield is the Chief Executive Officer and Managing Principal of the SAF Group, a Canadian alternative investment management firm with a global presence. In his role, he oversees the firm's strategic direction, capital raising, and investment management. He's active in participating in major transactions and realizations. Last week, I attended an award ceremony, and Ryan's fund won the best one-year return for a private debt fund. So Ryan, number one, congratulations on that win. And I did congratulate you last week, but thanks for joining us today.
Thanks, Bob. Appreciate the kind words.
Yeah, well, we try, right? So let's set the stage. Maybe just start by sharing a brief overview of your firm, SAF Group, your investment philosophy, and particularly focused on balancing income generation with capital preservation.
Sure. So I'll apologize in advance as I'm in the bowels of YVR right now if there's any background noise. But SAF Group has been around for just over 10 years. We have 40 professionals. The business started in Calgary. We have an office in Vancouver and just opening an office here in Toronto. We allocate about 750 to $1 billion a year, all towards Canadian credit opportunities. Given the focus on the Canadian sort of non-bank market, we tend to cover a fairly wide surface area of sectors that we focus on and investment structures. We really bucket them into our direct lending and opportunistic credits, but those investments can take the form of first lien, second lien, and structured credit investments. The business has predominantly been capitalized by closed-end funds and SMAs. So we've launched 8 of those since inception. And as you pointed out, we do have one open-ended fund, which was recently won an award, which often doesn't mean you win many after that with a one-year performance. But needless to say, that fund has been up and operational for just over 3 years. And it is an open-ended structure relative to the rest of our assets. It's relatively small. It's about 200 million. And that fund is taking vertical slices inside of our closed-end fund flow.
Yeah. So Ryan, you're saying it's okay to win the 1-year award, but then you don't want to be a 1-year wonder, right? One hit wonder.
That's exactly it. So, we'll take it nonetheless. I'm sure everyone read about it on Bloomberg.
Exactly. Yeah. So, we're here tonight and, our audience are high net worth families. They are looking for ways to generate income. Just talk in simple terms about the kind of things that your firm does to generate income for investors. Like, how do you go about making that happen?
Yeah, so we're a private credit firm. So our returns are coming by contractual obligations of our borrowers to repay us. At SAF, of the 4 to 5 billion that we've deployed, about 60% of that has fully realized, which sort of triangulates to about a 3-year average weighted life inside of our loans. So you tend to have a fair bit of churn inside of the portfolio, or we have historically, and would anticipate that going forward. So the return attribution over those 3 years is predominantly coupon, which is a contractual coupon, and accretion of discounts, which is just really another form of fees, and call it note appreciation. So that all comes back on an annual basis in its entirety to our LPs or our investors. To date, we don't have warrants, equity derivatives, equity-linked products, or royalties that make up any of our return attribution. It's almost entirely in the form of interest income. Of that 60% of assets, though, that have repaid, about half of them have been subject to a make-whole payment. So we do have some capital gains income that comes into the portfolio by virtue of borrowers repaying us early relative to the maturity date, or that makes up roughly half of the realizations we've had to date. In the portfolio, we have no PIK or other forms of capitalized interest.
Right. So I know when you said the word fees, you're talking about fees that you generate for the unit holders of the fund, as opposed to fees that you charge them.
Yeah, we may charge a borrower things like an application fee, a renewal fee. Any income that's generated off the investment goes out to our limited partners.
Mm-hmm. Yeah. Now, again, speaking as though I am working with the high net worth family, families like ours For families like ours, protecting our capital is crucial. How does SAF Group structure its private credit and special situation investments to manage and minimize risk for us?
Well, I think everyone on this panel would agree with, first and foremost, you own your cost base. If I may use a real estate term with these other professionals, if you provided a mortgage at a 90% LTV to a Toronto studio condo in 2021, you better hope that that condo is worth more than 90%. So you always own your cost base. You must stay disciplined with a function of that. You can never trade out of your cost base. And generally speaking, with private markets loans, or specifically opportunistic credit where we traffic in, you don't have a deep secondary market to be able to move paper if risk is starting to change on you on repayment. So number one, you got to control your cost base. For us, when we're investing in sectors like energy or metals and mining, where they're price taker markets, or they're subject to commodity prices, we certainly require our borrowers to enter into relatively robust hedging programs. But if we don't believe, on basket that those hedging programs of several of our loans are robust enough, we might enter into portfolio hedging and use excess return inside of the loans to pay for those hedges. We will often look at uniformed loans that we have inside of the portfolio to enter into the insurance market and enter into NPIs or non-payment insurance. If you have whole loans that demonstrate very uniform default rates or very uniform collateral performance, that NPI can be sort of a clever way to kind of hedge collateral risk inside of the portfolio. When we're entering into those types of transactions, we'll actually usually put back leverage on our investments in order to not degrade the total return profile to pay for that NPI. As far as protecting the return of the investments, I think, when rates are going up, and we would have flipped our book at SAF to floating in 21 to participate in rates, we actively start pushing interest rate floors on our borrowers by offering incremental duration or incremental maturity to those borrowers. And if we're unable to earn high step-off floors, we'll look at having the borrower pay for us to enter into floors synthetically on their behalf. That protects the return when rates start to decline, like we're seeing today. But ultimately, in a corporate market or corporate issuer market that has very thin M&A like Canada, I think it's just most important to ensure that you have your cost base and your original leverage correct. And probably the best test of that is if the business can intrinsically repay you through scheduled amortization via the free cash flow of the business.
Yeah, so it's similar to people who are used to having mortgages, that you want to make sure that you've got all the terms working in your favor, but then based on what you just said, you work pretty closely with your borrowers to make sure that their business is continuing to function in a way that they'll be able to honor the loans that you have put out to them. Is that a fair statement?
Yes, we're not buying indentures. These are privately negotiated transactions that tend to have pretty robust credit agreements that allow for sort of active maintenance of the business.
So 10 years, I know that you just had your 10-year anniversary party out in Calgary. If you look there, because we're still focusing in on the risk side, what's the worst performance period that you've gone through?
Yeah, we look at them on a fund by fund basis. Our worst performing of those 9 funds was an 8% rate of return over 7 years, or 8% per annum for 7 years. Our loss rate, I think, is 30 basis points per annum over the past 10 years, which is really a function of one of the loans we've made over the past 10 years. We aim to sort of generate 10 to 12% returns net of all fees. That being said, if you had invested an equal weighted dollar across all of our funds, it would have generated you a per annum return of just over 15%.
Just over 15 with minimal periods of downtime.
Yeah, I don't think there would have been any downtime.
No downtime at all. Yeah. Consistent income, for most families is another priority. What type you've talked about that the yields probably in the 10 to 12% range. What do you do to try to ensure that you stay within that window?
Yeah, well, you certainly have like diminishing participation when rates go higher as, base rates of risk-free rate hit sort of like 6% or maybe five and a
Mm-hmm.
half percent.
Mm-hmm.
And, equally you get accretion with a sort of convex interest rate curve. So when rates start going down, as you start to get to around 3%, you stop sort of equal participation in those, rate decreases.
Mm-hmm.
We try to use forms of back leverage as buffer inside of the fund. If we have a floating rate loan where the total return profile is dipping on a gross basis into the 10% range, but we have a deeper tranche inside of that loan that we can back lever on a non-recourse basis
Mm-hmm.
to move the total return profile back to 12%. We will do that on an active management basis.
Mm-hmm.
That allows us, really to hang in most of our returns, from our funds between that 15 and 8%.
Now, just because we're up against the clock, we're kind of keeping on track here. What areas do you see right now that are emerging areas of or strategies that you're exploring?
So today, we've been quite busy lending to providing credit to non-bank lenders. Um, Providing first lien and second lien credit facilities to pools of mortgages. We've really started deploying capital in 2024 or this year. And over the past 8 months, we've allocated just over $500 million to the space. So we think we're kind of in the fifth inning of that, and there's
Mm-hmm.
still an opportunity set available. Back in 2021, we're quite busy in energy. We put out kind of around 700 million to energy companies. 21, 22, most of those have repaid. We think with a Trump administration and quite frankly, tough gas prices and oil prices looking like they might be in tough, that the shin of the boot, being a Canadian producer, may provide some opportunity to earn some fair risk-adjusted returns.
Yep. So the word that you use constantly through this is opportunistic. You're looking for areas where there are great opportunities with minimal risk, just so that you can provide the returns to investors that you're hoping to. Is that a fair statement?
It's a very fair statement.
Very fair statement. Okay. Well, just stay on track, Ryan. Thanks very much for sharing this information with us. If you're able to hang around, I know you've got to jump and you're at the airport. So we really appreciate you doing this for us this evening. And thanks very much. We appreciate it. Okay.
You bet. I'll hang on the line until they tell me to turn off the phone.
Okay.
Thank you.
Perfect. All right. Thanks. So next on the agenda is Will Granleese. Will is director and portfolio manager at Antrim Investments, a company that we've been working with for quite a while. They are Canada's largest residential mortgage investment corporation, MIC, if you hear that term. Will, like Ryan, it's interesting to try to put these together and find a dozen people over a 3-week period where you can fit into their schedule. Will just returned, just yesterday from a family vacation. So thanks, Will. We appreciate you fitting us in and hope you're feeling refreshed and relaxed for this evening.
Happy to be here. Thanks for the invite.
Yep, as usual. So again, looking at it from an investor point of view, how does Antrim generate income consistently, even during some of these fluctuating real estate markets that we've been experiencing?
Yeah. So at Antrim, what we do is we provide first and second mortgages to individuals in Canada, and we provide them with a 1-year fixed rate. So it really doesn't matter what's happening to interest rates over that 1 year. We consistently get that rate. Our average borrower will stick with us for about 3 years. So you combine the fact that when someone joins Antrim or they take out an Antrim loan, they've got a 1-year term, and the fact that they're with us for 3 years really helps to smoothen out any volatility on interest rates.
Yeah. So you're talking 1 year, you're just doing 1 year loans.
Yeah.
So
Yeah.
that really helped your investors as rates just skyrocketed. But now you're in a period where you're starting to roll those over at much higher rates. Is that what you're seeing?
Yeah. So about half of our business is the renewal business, is we're just simply renewing existing loans that we have, and then half of our business is doing new business. I would argue the past 2 years have been very interesting for any private lenders because there hasn't been a time where we've seen, 10 Bank of Canada increases in 14 or 15 months, whatever it was, right? It's quite a scary time, honestly, for us. We weren't sure if our borrowers would be able to afford these payments at, a 10% rate, right? We didn't know. They were able to do it during the financial crisis, but we weren't positive whether or not they'd be able to do it this time. So again, we have some levers that we can pull, and in this particular case, we renewed some people at their old rate. We didn't bring them to the new rate, and on all of our new business that was going out, we increased the rate to whatever the market rate was. We did our diligence. We made sure, yeah, you know what, our borrowers can afford this. This is all working out, and then we hit the switch and started to renewing everyone into the current rate.
Yeah. One of the things, Will, that we see is, we get calls all the time. Hey, can you invest some money with us? And we're a mortgage fund, whatever. And my usual question is, so how many mortgages do you have? And they say, yeah, we've got 60. We look for diversification. Diversification is our best friend when it comes to managing risk. How diversified is your portfolio?
Yeah, I think we've got about 2,200 individual loans. So there is no mortgage in our portfolio that's worth anything, near 1% of the portfolio. I think that's sort of the strength of our business, the fact that we do have that great differentiate or that great diversification. The average loan size is about 420,000, about that. So just think about all of our loans on residential house, detached, townhouse, or condo in major centers of Canada. Because what we found is that should a file go into foreclosure, and we never want that to happen, but it's part of the lending business, it does. Should a file go into foreclosure, we want to make sure that there's always an active liquid market in that area. And so we stay away from small town Canada, and we stick to just the major centers that we can get out on and sell the property by way of foreclosure should we ever be required to do that.
But if you do need to foreclose and you look at across the board, kind of what's the equity to loan value percentage?
Right. So the weighted average loan to value, or the percent of the loan as opposed to the percent of the house value, is about 59%. It's crazy to think that the average borrower that we lend to puts down over 40% down payment, right? So, okay, why aren't the banks doing these mortgages? Like, what's going on here, right? And so our average borrower is middle-aged. Let's say they're 45 to 65 years old. They are self-employed, which is very key. And they've owned real estate for over 10 years or more. So they've ridden up this massive increase of equity, and they maybe want to buy another property or they want to do something, but the bank looks at their income statement and says, I can't make you qualify for this mortgage. The rules on qualification for income are so strict now that they can't. So what they might do is they might say, okay, we have a lending partner. Their name is Antrim Investments, and they focus on lending to people like you that are equity rich, but can't prove the income. People that have great credit, but again, can't prove the income. And so you're going to go and borrow with them for a year or two until we can requalify you back at the bank. And we see a lot of that happening as well.
Yeah, it's always interesting to think that banks are sending you business so you can send it back to them in a few years, right?
Absolutely unbelievable. Yeah.
Yeah. So you've got the equity in the properties that if you do have a default, you'd have to, especially when you're only looking at 1 year terms, You'd have to have a pretty significant drop in real estate prices before your portion, the mortgage portion, is going to get in trouble.
Yes and no. Yes and no.
Mm-hmm.
So our offering documents allow us to lend up to 75% of the value of the property.
Mm-hmm.
We do it very rarely, very, very rarely, but we do.
Mm-hmm.
So from our experience, if we lend to 75% of the value of the property and the market is stable, there's no drop in house prices, by the time the foreclosure goes through and the property is sold, we typically get out with all of our principal investment plus all accrued interest.
Mm-hmm.
But there's not a lot left over for the borrower, because there's realtors to pay. There might be a slight drop in the house price because everyone knows this is a foreclosure, and if it's a foreclosure, we can't accept any bids that have subjects on them. So there's all sort of intricacies, but in general, if we lose money on a file, it's very rare. For example, the last 6 or 7 years, I think our average loan losses on $1 billion portfolio have been like under $25,000.
Mm-hmm.
So it's rare.
Yep. Yeah, I was doing some math on that if you've got $1 billion of AUM, of assets under management, you've returned around 8%. Means you're paying out 80 million, if I've got the decimal in the right place, right? You're paying about $80 million out to income investors every year. Did I do the right math on that?
Well, yeah, I mean, like I say, we've been in business for over 50 years, and I would argue that our average interest rate over those 50 years has probably been 8%.
Mm-hmm.
But we have just come through a remarkable period of low interest rates, right?
Yep.
And COVID was just at the very end of it. So I would argue over the past 10 years, we maybe have only paid out, 6.5, 6.6 or something like that.
Mm-hmm.
But now where interest rates where they are today, we're paying 9%. So
yeah. So for income investors, 9% sounds a little better than 4% GICs in my books, right?
Well, when you look at all the other features that we have, which is our stability, our share price doesn't change.
Mm-hmm.
So we're almost looking to act like a supercharged term deposit, honestly, in your statement.
Mm-hmm.
It's almost like this Antrim term that is paying you typically 3 times what the 1-year GIC rate is paying.
Yeah. So, Will, if we were to, again, just stay on track, if we're going to look into the future, how do you see the real estate market, and what should an investor expect if they have money with you over the next 2 to 3 years? And maybe just touch on, while we're at it, just touch on liquidity. How quickly can they get their money if they need to do so?
Right. So we offer liquidity of T+2, which means the trade date plus 2 days on a best efforts basis. So we've done that for the past 35 years, but we say on a best efforts basis, just in case everybody wanted their money back, we might have a bit of a fail-safe. So finding a mortgage lender willing to redeem on a T+2 basis is very difficult. Typically, mortgage lenders will be, you can get your money back, but it might be 30 days or even every 90 days on the quarter. So that's really what makes us stand out, is the fact that we are so liquid. As far as the real estate market goes, this is my personal opinion. I don't think we're going to experience the growth in the residential real estate market that we have the last 20 years. I just don't see it. I don't see the ability to pay these much larger mortgages. I don't see it. The good news is that investing in Antrim, it doesn't matter that the house doesn't go up in value, right? Because we're a way of investing in real estate without actually owning real estate. So we're a way of, when you take a mortgage on a property, you just have the mortgage. You don't have to deal with the broken sink or the leaky faucet or something like that, right? So for us, a stable real estate market, which is what I would say is going to happen over the next 10 years. And primarily this is happening because of the housing crisis that we have, right? There's not enough housing to go around. So we basically have this Goldilocks zone that we're operating in right now, in which case housing prices can't go down that much, and interest rates are relatively high. And so, yeah, I foresee our rates coming down a little bit, over the next year, maybe 8.5%, down from 9%. Projecting further than that, you just can't do. We don't know what's going to happen. But regardless,
hard to predict the future. Anyway, to
Indeed.
keep on track,
Yeah.
thank you, Will. We'll next move on to Sean Rogister, Cortland Credit Group. Sean is the CEO of Cortland Credit Group. He's got extensive experience in managing fixed income investments. If you saw his bio that we had posted at the beginning of this session, you probably saw that he handled money for teachers' pension plan in the past. But he's a guy who has been there generating income in uncertain markets for years and years. He's been a regular on the My Private Network podcast. He brings, as I said, years of experience managing money, and we're glad to have him here this evening. Sean, thanks again for reaching into your evening and spending some time with us.
Bob, thank you very much for your complimentary introduction. I greatly appreciate the opportunity.
Yeah, thank you. So, Sean, we're looking for income beyond that which GICs and bond funds can offer in today's market. How does Cortland Credit provide stable income for investors like those who are on the call this evening?
Yeah, Cortland runs a private credit fund that specializes in commercial loans to small to mid-cap companies. We're always in the senior secured status on their balance sheet, and it's always asset-based loans. So we are providing these loans to small to mid-sized companies that are underserved by traditional banks. They tend to be profitable. Well, they are going into it always profitable firms, but they need our capital to fund their growth. And the borrowers are aware there's a risk premium for private credit, but in general, they're hoping to grow to attract traditional bank financing. And until then, our investors get the benefit of this stage in their development. So in almost every environment with this risk premium, we expect our private lending model will provide a yield that's above that available in bonds and GICs.
Exactly what we're looking for here this evening. Now, you talked about senior secured. We want to keep the language fairly simple for the people who are on the call. Short term, I think people understand. What do you mean by short term, first of all?
Well, short term for us means 12 to 18 months. Generally in the market, anything under 2 or even 3 years, but we're 12 to 18 months and on average and always under 2 years in term.
Yeah. And now senior secured private.
So
what do you mean by senior secured?
It means that the loan principal is always fully collateralized by real assets that are we're the first claim on those assets if something goes wrong at the borrower level. So in a default, and they have to liquidate the assets. We're the first out, the first protected. It's like the first mortgage on a home.
Yeah, I guess Will was talking about it's easy. He's primarily in the Toronto market and the Vancouver market, which is really quite liquid. How liquid are some of these assets that you are securing to support the loan?
Yeah, so it's very interesting. We always do appraisal on the liquidation value, and the liquidation value is if you're forced to sell, so normal liquidation value. We also are very focused on assets that are the liquid working capital of the borrowers. So it's a revolving loan for the majority of our loans. We do some term, and I'll go into that in a bit, but the revolving loans are backed by revolving assets. So the accounts receivable, a little bit inventory and other revenue based assets, but they're turning over on a frequent basis. There will be hundreds of accounts receivable counterparties, provide great additional diversification and a lot of the security that supports this. But the main thing is that even if they go into bankruptcy, you don't have to chase down and liquidate those loans. You wait the 45, 90 days until they mature and collect that cash. And we have the blocked accounts that give us first sweep on all the cash that comes into the borrower's bank accounts and a few other things like that. But it's always that short-term liquidity available for support of the principle of these investments.
So if we were to look inside your portfolio and you were lending against receivables, you've got a pretty diversified portfolio in there because you're not lending to the borrower per se, but you might be lending to anybody from Costco to the government of Canada. Is that a fair
Well,
statement?
we always lend to the borrower. So we structure the loan so going into it, we expect them to be able to repay the loan out of the cash flows that they generate. But if anything happens to those cash flows, we always have the underlying assets as collateral to back us up and the investor capital through any what they call enforcement or default proceedings, CCAA proceedings that would go to courts.
Yeah, perfect. Now, private debts has become, I was going to say become popular. It's still, in institutional world, it's very popular, but for the individual investor, it's something that people are just learning about. And, hopefully we're helping to educate people on the call this evening. If we were to be looking in a portfolio and we wanted to add private debt, private credit to a portfolio, why should we choose a firm like Cortland Credit as the firm to work with?
Well, Cortland Credit is quite a bit different than most of the private lending out there. Our loans in the 12 to 18 month range means that they're shorter than most of the loans. Certainly for commercial loans, most of the private credit is 3 to 5 year term loans with very little liquid redemption rights available to them. And they certainly are, if they provide additional redemption rights, they don't necessarily have the capability to deliver on it if they have any other problems in the portfolio. So the big differentiating characteristic of our strategy is that it's short duration assets matched with the short duration liquidity that we offer our investors.
Okay. Now, speaking as that high net worth family, we're pretty cautious and we need assurance that our capital is secured. Just using performance as a gauge for that, what's the worst period that Cortland Credit has experienced? I know we were barking at you a couple of years ago because some of the rates were appearing quite low. But what's that worst period you've been through, and how did you manage through that?
Yeah, the worst period we had was subsequent to a large repayment by a group of borrowers, and then a bunch of new investor capital came in. So the returns I'm going to show you were a function of dilution due to excess cash. And we've since changed our investment policy controls that would restrict this from ever happening again. But the worst return was in 2021 when we had a 3.5% annualized return, return for that year. It was not due to challenges in the underlying assets, but just excess cash that grew. We've since changed the investment policy. We can't have cash above 15% and accept any new cash from investors. And really, we've been running in our target range of 5 to 10% since then. We're actually a little low on cash right now, towards the around 1%. But we are, we're running in an environment that is there's a lot of demand for these loans, and we don't use leverage in this fund, so those returns are standalone.
Yeah, and leverage is a word that I think a high net worth family should look at when they're making investments. Is that leverage is great when things go your way, but not so great when things are going against you. So I think it's important to hear the words that Sean's saying, that very little leverage in the portfolio. Now, I remember, Sean, back when you were doing the 3.5, and we were barking at you all the time, is that it was a combination of repayment of some loans, but also I think just based on your performance, you'd taken a fair bit of new money in as well. Why was it so difficult during that period for you to have excess cash in the portfolio?
Yeah, so we've grown very fast over the last 11 years since we've been in business. And through that period, prior to that period, we had never had any challenges putting any new capital to work in kind of 6 to 8 weeks, maybe maximum 3 months. And so 2021, if you remember, was just in the later stage of the COVID pandemic, and we were having trouble getting lawyers to come into the office, getting them to look at deals. They were buried with all the other nuances that go with managing risk for the banks and the other places that a lot of our lawyers do work for. So we really just couldn't move forward at the normal pace. We really beefed up our origination team since then. So that's the team that sources the loans. And like I said, we had never had that problem before. It took a little while to adjust to it. I think we've done that now.
Mm-hmm. Yep. So you had an issue, you learned from it, you made adjustments.
Right.
And that's good. So looking forward, well, I think I want to talk liquidity first. High net worth families, sometimes they need money. If they need money, how quickly can they redeem part of their investment if it's invested with Cortland Credit?
Yeah, so we offer 45-day redemption rights prior to a month end. We work very hard at maintaining a portfolio of loans that are also short term. You'll see the average term in our loans is somewhere around 6 months. And that's for including a small amount of the minority of the portfolio that is in short term loans out to 18 months. So across the board, they're very short, and we have been very careful to make sure that we deliver on those redemption requests as they come in.
Yep. So if you need money, you're talking 2 or 3 months to get your money.
That's right.
Yep. Now, again, crystal ball stuff, looking forward, what should investors expect if they've got money with Cortland Credit, let's say over the next 2 to 3 to 5 years? And where do you see your market evolving?
Yeah, so we are a floating rate lender. We've always been that lender that lends as a spread over money market reference rates. And we're going to be at prime plus 2 to 5%. Prime is going to be a couple points above T-bill rates. So you're looking at currently, 5.95% prime, and we're going to be in the 2 to 5 points above that.
Yep. So that's a reasonable expectation. But people do need to watch rates. We've gone through a period where rates went up so quickly. Investors with you participated in that hiking of rates. As things come down, you're probably going to be a little bit quicker for your performance numbers to come down than maybe somebody like Will, where he's got 1 year sort of fixed rate loans, takes 6 months to get through that portfolio. Is that fair?
Well, a unique part of our model is the floored floater model. So we lend at a floating rate, but with a floor.
Okay.
So we are, especially any of the loans we've done in the last 2 or 3 years when rates have been higher, they have a floor that might be 9.5% to 11.5%. So they're going to be a lot stickier on the way down, and that'll be over the term of the loan that floor stays in place. And that's what we're seeing is as rates have been falling here, we're dropping, for every 25 basis point drop in the central bank rate, we're down about 8 to 10 basis points.
Perfect. Okay. Staying on track. Sean, thanks for joining us this evening. We're going to move on to Adam Dean, CMLS Asset Management. Adam is Vice President and Portfolio Manager at CMLS, where he manages mortgage investment mandates. So again, similar to the work that Will does at Antrim. CMLS is in the same markets, but they do things a little differently. So, Adam, thanks for batting cleanup on tonight's panel. We appreciate your participation. How you doing tonight?
I'm doing well. Thank you for having me, and thanks everybody for joining.
Yeah, learned anything from the previous sessions at all, or no?
You know what? I think it's very clear that private markets are compelling in their simplicity. So I think I'll be touching on a lot of the same themes that Ryan, Will, and Sean did, and hopefully adding a little bit of additional insight.
Yeah, that'd be great. Okay, so back to, we're a high net worth family. We are looking for safety of capital. We're looking for good income, but not at the risk of our capital. As we look at the work that you do, how is it quite different than working with a typical MIC, somebody like Antrim?
Yeah, I mean, I'd say in a lot of ways, it's very similar. I mean, we deliver income to our unit holders by building a diversified portfolio of residential and commercial mortgages. And when I say residential, that's a mix of single family residential, so people's homes, and also multi-residential, where there's multiple tenants at the property. And we pass on the income from those investments, and that's in the form of both interest that's paid by the borrowers and also the fees that we charge, or participation in the fees that we charge to those borrowers for obtaining the loan, and that goes through to our unit holders. I think what makes us stand out relative to the broader mixed space is just our organizational scale. So the CMLS Mortgage Fund sits within what I'll call the ecosystem of CMLS Financial and Nesto, who provide mortgage investment solutions to a very broad range of institutional investor clients. So these are the largest financial institutions and banks in Canada, and also the largest mortgage investment managers. So with that, that allows us to engage with a very broad range of borrower clients and a range of risk profiles across those mortgage investments. So if you look at CMLS Mortgage Fund, this is a vehicle that we created that, among the $15 billion of mortgage origination that the broader organization is active in each and every year, we can pick and choose those mortgage investments that fit our risk and return profile and that we're comfortable with the fund.
Yeah, I think that's a major point from an investor point of view, isn't it? That it's a good thing to have a big brother that you can work with, where you can kind of tag along with the work that they're doing, but the fact that you can kind of cherry pick their portfolio is probably a good thought for investors.
Yeah, I mean, mortgages, they generate excess return because they're harder to access and they're harder to invest in. It's very hard for an individual to independently build a diversified portfolio. And so if you're working with groups that have scale, like all of us on this call, you can just be comfortable that have the risk controls, the governance, the market presence, the market knowledge to be investing in a responsible manner and protecting your capital.
Yeah, we hear stories all the time that, these mortgages, I don't know how that works out. I lent money to my cousin Billy one time and I never saw a dime of it. We want to stay away from that. I think if you're going to invest in mortgages, look at working with a professional firm like yours versus trying to just do piecemeal loans to family members. Now, one of the areas that you're different than Antrim and what Will was talking about is that you do a pretty good portion of your portfolio is split between personal, private mortgages, and the second biggest chunk is multifamily properties. Why do you like investing in multifamily properties? And when I talk multifamily, we're talking apartment buildings.
Yeah, so I think residential, whether single family or multifamily, it's an essential need as shelter for the population. And Will touched on it. When you have a limited supply of that essential need, the property values become highly resilient to negative external factors. It's why we have a significant affordability challenge in this country, and why we have very kind of high and sticky both home and rental prices. I think what we like about multi-residential properties, and again, we invest in both single family and multi-residential, we really look at the lines of defense that we have in an investment. When, as a mortgage lender, we're not participating in the upside of the property, we're only exposed to the downside. So we look at the last line of defense being the property value, which again is, in these markets, we're comfortable with the resiliency of those values. But the first line of defense is the borrower's ability to repay. And, that can be looked at in two key ways. First is the borrower's financial capacity, and that may be other properties they own, sources of income, et cetera. And second is the rents that are generated or able to be generated at the property. So we find that in multi-residential, we have that extra line of defense where there's income being generated at the property. And then what we try to do in our fund is, when we look at the financial capacity of our borrowers, when we're participating in loans that are on larger properties, that typically coincides with larger, very well capitalized sponsors. So across our multi-residential component of our fund, the average net worth of a sponsor who provides their guarantee on those loans is over $300 million. So we have a lot of resources behind these, that if for some reason vacancy increases at the property, tenants can't make their payments, and the property itself doesn't support the loan, the borrower has significant resources to draw from elsewhere to ensure that they continue to make their payments. And we see that in the performance of the portfolio.
Yeah, so you can see a parachute.
Yeah.
Always safe to fly with a parachute. Now we've seen recent interest rate fluctuations. How has your fund, that investors like those on the call this evening, how's it performed, and how have the fluctuating rates impacted investors?
Yeah, so I think in the most significant way, it's the interest rates that we receive on our loans in the portfolio and ultimately are passed through as returns to the unit holders. Very similar to other investments on this call, we structure our loans as predominantly shorter term. They're 1 to 3 years. In some cases, they're fixed rates like Antrim. In other cases, they're floating rates with floors, like Sean's structure. And what this means with that 1 to 3 year term is that when interest rates start to evolve in the market, you typically see our fund start to respond, or the returns of the fund start to change about 1 year out, and then gradually move from there on. So when we saw rates spike kind of at unprecedented speeds in 2022, we went over the next couple of years from a 6% return at that time to around 8.5% in the last 12 months today. And we'll expect to see that same pattern as interest rates come down, with some resiliency given the duration and the floors and the fixed coupons. But over time, you will see the returns come down. And I think it's important to be prepared for that, given that, we're not focused on a specific percentage return. We don't feel that that's appropriate, because what we'll need to do if we're targeting an 8-9% return is we'll have to shift our risk profile to meet those when rates are coming down in the market. And we'd rather be focused on maintaining a consistent risk profile and then crafting our return target in a relative fashion. So what we look to do is we look to deliver 3% or greater over the 2-year Government of Canada bond. Now, today that return is 5%, but we like to focus on having a minimum return of 3% over the GOC.
Now, bad debts. Have you had many in the last few years? And what do you do? What do you do to protect investors other than having pretty high levels of equity in the loans that you put out?
Yeah, so I think, that's the second effect of rising interest rates, right? It's just the potential challenges in the borrower's ability to pay. So, if we have a loan that's at 6% and it's maturing, and we offer a renewal at 9%, there can sometimes be concerns in the borrower's capacity to pay. But we tend to focus on, again, strong credit borrowers and borrowers with high levels of financial well-being elsewhere to support the payments. So what we did see in about September 2022, after rates had started to increase, we went from running typically around 0% arrears in the portfolio. And by arrears, I mean loans that borrowers have not made a payment in more than 90 days. And that crept up to about 2%. And it stayed at 2% for about 2 years' time until about Q2 this year, where it started to migrate down towards 1%. Now, that's actually all in our single-family residential component. Throughout that entire period in the last 5 years, we've had 0 payment delinquencies on multi-residential component and our commercial, just given, again, the sponsorship quality that's in that segment of the portfolio.
Okay, so just trying to wrap this up a little bit, flexibility. How quickly can people get their hands on their money if they were to invest with you?
Yeah, so it's a constant balance for us of just looking at making sure that we match our policy up with the inflows and outflows and our underlying investments, and when our investors need their capital back. Our policy is redemptions on a monthly basis. So if investors give us a call, let us know that they would like to redeem by the 15th of a month, that capital will be returned in the 3rd week of the month following. So it's about a 5-week waiting period. Now, it's liquidity is not an issue. This year we've had subscription activity, which has been 7 times the redemption activity. So in reality, our ability to satisfy those requests much sooner is there. But we like to keep a policy that, when times aren't as good, we're still going to be able to, support our investors' need for redemptions and just manage expectations accordingly.
Mm-hmm. Okay, well, that's perfect. Thank you very much. So now we'll open things up to Q&A. If anybody has, I think if you look at the bottom of your screen, you'll see there's a Q&A button there that if you just want to type in any questions that you may have for our panelists this evening, I think that'd be a good thing. So let's talk, the question that I've got here up on the screen is about how, it's structured. So I have a portfolio. I've got 60% equities, 40% fixed income. And, I'm kind of frustrated by the bond portion, the 40% that I've got in bonds. If you were to take Antrim and put it in the portfolio, it fits into that fixed income, is I think the way I'm reading this question. Does that make sense to you?
Yeah.
How would you, like, what percentage of somebody's money in a portfolio should be directed to a MIC or a mortgage fund, do you think?
Yeah.
Is the question.
The key is to be diversified, right? And so clearly a 60-40 split, stocks and bonds, you're not fully diversified. So, you have to do what the university endowment funds and the Canada Pension Plan and everybody else does, and explore the options in the alternative world. I would argue that an individual should not have any more than 10% of their funds in any particular fund, right? Yes, we have many investors that have a lot more than 10%, but I don't think it's wise. I think there's a lot of other great alternative investments that we're talking about here tonight. What I see happening is I see up to 20% of an individual's portfolio being allocated to alternative funds, right? Maybe you have 4 alternatives, and maybe Antrim is one of those 4. So you have, let's say, 5% in Antrim. That might make sense. But yeah, I would argue typical bond funds are not going to get you to where you want to be in the future. I don't see great rates of return. As a matter of fact, we were having a chat before this all started, and Bob, you said, I think over the past 3 years, bond funds have had a negative rate of return. So, yeah, I would argue between 5 to 10%, typically alternatives, maybe 20% of your overall portfolio. That's what I would normally say.
Diversification's your friend.
100%.
Yeah. So Sean, all the work that this question is, Sean, from Teachers Pension Plan and the work that you did over there, how does that translate to working with individual investors in their portfolios?
Yeah, the question for the need for bonds and bond funds, where they're public securities, you can get out within a T+3 basis or T+1 to 2 basis days, is relevant if you need access to that capital. If you have confidence that you will not need 25 to 40% of your fixed income capital, then I think that can go as a reasonable allocation to alternatives. And I would say that it is important to have a mix of fixed and floating, because there's a big challenge with the fixed world that if interest rates back up, then you're not going to get a positive return on that side. And that's offset if you have floating rate exposures, as long as they have a decent yield. Obviously, T-bills are not going to have a decent yield in most environments. Currently, we have something of an odd yield curve where T-bills are generating some decent returns, but it's very unusual. So I would throw out to you that floating based assets, and I've heard a couple different strategies here today that are floating. So that's a very good mix, or an addition on the diversification side. And then, all of the strategies I've heard today are fairly well diversified, although, if you look at strategies that are allocated to a single sector, you're going to have a little less diversification. The broader your sectors that you're exposed to, the more diversification you have available to you.
Okay. So I'm going to give next question I see on my screen here is for Adam. And it's It's about high interest savings accounts. There's some pretty good rates it's saying here on high interest savings accounts. I've seen those as well. Why are some of these firms doing such high yields on their high interest savings accounts, and why are they doing it, and what's going to be how's that going to turn out for investors, do you think?
I think it's it's a similar point to what Sean just mentioned, that those, you have to be, it could be that you need the money in a very short period of time, and so it's not necessarily looking for a long-term stable investment. Those interest rates are going to fluctuate over time. Typically, the high interest savings, there's a defined term on that. And then at the same time, when you're looking at the type of private asset exposure that we have here today, and that you're quite active in explaining and promoting on your podcast, Bob, is additional return. And ultimately, why is there additional return? It comes down to what I said, that these are investments that are harder to access. The underlying investments are illiquid. And so, working with experienced partners of scale, like those of us here, allow you to access, higher returns, relative to those savings accounts for the right type of capital and in a diversified portfolio.
Mm-hmm. Okay, so just to wrap things up, I think that's the end of the questions that I have on our panel there. So appreciate everybody who sent a question in. Now, just to wrap things up, thank you to all our panelists and everyone who joined us tonight. This evening, we've gained valuable insights into strategies for generating income and preserving capital, even in uncertain markets. Now, each of our experts has shared thoughtful perspectives tailored to conservative investors, like most of the people who are on the call this evening, who prioritize stability and steady income. Now, I hope tonight's discussion has provided you with deeper understanding of some of the options that are available to you for building a resilient investment portfolio. Before we let's just talk next week. Next week, we'll be looking at the second session of Investing for Income. Our guests are Mike Meekins, president of Westbridge Capital, discussing diversified private debt with equity participation as a booster to help with returns. Jeff Lang from Equiton, sharing insights on investing or income from Canadian multifamily apartments. So a little different than Adam's talking about. This is more involved in the equity portion of multifamily. Chaim Karpel, Vice President at Peak Hill Capital, who's going to talk some different angles that they have about working in the mortgage market, and Gabriel Millard, who's a managing partner at Avenue Living, who's going to talk about how you can generate income from all of those self-storage facilities that you see spotted around Toronto and North America. Now, each speaker will bring unique expertise and perspectives on alternative income generating strategies. So, mark it in your calendars. I think a lot of the people who signed up for tonight also signed up for the next two sessions. If you haven't, take some time, and hopefully you gain some information tonight that we'll want you to come back, because we know you have choices, and we appreciate that you made the decision to spend time with us this evening. So just to kind of wrap things up, if you have any additional questions, please feel free to reach out to us at Wealth Stewards. My email address is bsimpson@wealthstewards.ca. That's bsimpson@wealthstewards.ca. Or if you want to call me, my direct line is 905-502-0100. We're always here to help. So again, if you haven't signed up for next week's session, please do so by visiting privatedebtandequity.ca, clicking on events, and you should be able to find it there. But thank you. We said we try to get you out of here by 8 o'clock. We're 8:06. We're a little bit over time, but thanks, gentlemen, on the panel. We appreciate you, and we appreciate your time that you spent with us this evening. And to all of our participants in this, we appreciate that you've come out this evening and shared and spent some of your time away from family. So thank you so much and have a good night. And hopefully we'll see you next week.
Thanks, Bob. Thanks, all.
Thanks,
Guys.
Bob.
Yeah, thank you. Before making any investment decisions, it's crucial to consult a professional advisor to determine suitability. Full disclaimers are available on privatedebtandequity.ca. Thanks again for your time and engagement. We look forward to seeing you in the next session and continuing your journey towards financial security and sustainable income. Have a great day.